Most people who come into crypto don't actually understand the game they're actually playing. They think it's a game of charts, narratives, or just blind luck, and it isn't. It's actually a system designed to extract money from those who don't understand its laws. And once you learn these laws, you'll understand why you've been losing money and why the same people consistently win. So let's get right into it, guys. The 12 unwritten laws of crypto. Hades Alpha, market doctrine. Law number 1. Crypto is PvP. Eat or get eaten. A PvP battleground. Crypto on the surface may appear to be friendly. You have all of these lovely communities, you have all of these lovely KOLs, you have these leaders of projects, and it might make you think wrongly that it's actually a nice place to be. In reality, it's a fight for capital and liquidity, just like every single other financial market in the whole world. Every dollar you make from this game is coming directly from someone else. Someone is giving you that money. If you make $1,000 from a meme coin, you are stealing that $1,000 from someone else. And that's just how the game works. For most coins, there is very little to no cash flow or value being created. And even for coins that there is cash flow being created, like Pump Fund, that value, that revenue that they're making is from the expense of others, the casino that they're extracting from. So it's all an extractive game. It is PvP. It's just the raw truth of crypto. Negative sum dynamics. The actual makeup of crypto itself works against you. Slippage, MEVs, fees, exchange spreads, they drain liquidity from the system from you. Whether you like it or not, you're playing in an environment which you have to pay to play. Just like in the financial world that we live in. If you want to live somewhere in a city, you have to pay to play. You have to pay VAT in England. You have to pay rent. It's exactly the same thing with crypto. And it makes it negative sum. So a zero sum game is there is an equal amount of money being won and lost by people. A negative sum game is money's actually being extracted from the system. And this is exactly what we get with crypto. The rule. In crypto, you're either being extracted or extracted from. And there is no middle ground. Play and act accordingly. Law number 2. The game is rigged. Engineered for extraction. Dev of coins control supply. Exchanges control liquidity and extract from every single move you make. Market makers control charts. You're trading inside a casino built by people that profit whether you win or lose. And this is by design. They have got there first. They've built the infrastructure around you, right? Just like real estate. They own the properties. You have to rent off them in order to live. And this is exactly what's happened in crypto. It is a rigged game. And the invisible infrastructure is that the order books, volatility spikes, unlock schedules, random pumps are not random. They're systems designed around the incentives of insiders. The insiders always win and they're quiet. And the insiders in crypto will make you think they're on their side. When the exchanges are posting memes and make you think that they're on your side, do you really think they're posting this for your benefit? No, they're posting this to make you not question them, to make their power undisputed and for you to just see them as another ally. It's not true. They are making money off you whether you like it or not. So the rule is stop expecting fairness from crypto. Understand the game you're playing in. Map it out and then go and build an edge and beat the casino. And I promise you, if you do this, you can beat the casino. Because I've beat the casino. Many other my friends beat the casino. Many people I know have beat the casino. So you can actually do it, guys, okay? Law number 3, attention is everything. Crypto is all about attention. Attention in crypto is the lifeblood of crypto. Narratives move because of attention. Liquidity moves because of attention. Price moves where attention flows. Charts pump where eyes concentrate on them. Everything is about attention, and visibility creates liquidity. The upstream window. All attention begins in private circles, such as dev groups. When I say dev, I mean developers. These are the guys that actually make the tokens, okay? Dev groups, insider circles, small Telegram chats. By the time you see it on your feed, by the time you see a meta on your feed, it's been circulated through all of these insider networks already, and it's probably too late. That's why you have to try and get in before. You have to build an edge that will allow you to spot all of these trends before they make it onto your X feed. before everyone's talking about it, at least. When one or two people are talking about it on X, it's fine. When everyone is talking about it, it does become a problem. So the rule is follow attention, not narratives, because where attention flows, money also flows. Attention is the real asset of crypto. Law 4, tokenomics determine outcomes. Now, this is a very personal law for me because I've been screwed over a lot of times by buying into coins that had awful tokenomics. I'll give you a good example. RSR in 2021. I made a lot of gains from this coin. I made about a 30 to 40x, which is insane. But I held it for too long. And the tokenomics for this coin were inflationary, meaning that insiders were gaining tokens every single month and were dumping on market. And once the market turned for the worse, the price completely nuked because all of these insiders just started selling and they had an unlimited amount of tokens to sell. I'll give you another good example. Look at Bitcoin, for example, a deflationary emission schedule. Every single 4 years, miners have less rewards to mine. There's a limited amount of supply. Is it like 5 million Bitcoins or something? Correct me if I'm wrong there. It's a few million Bitcoins. Limited amount of supply, deflationary emission schedule. That's why the value of Bitcoin is going up against the US dollar. Because the US dollar, the Federal Reserve can print as much as they want. And there is no limit as to how much they can print. But with Bitcoin, it's deflationary. And this is why tokenomics determine outcomes. I haven't even read what I've written yet, but I know what I've written. I'm talking about meme coins. Meme coins where insiders hold a lot of supply and they eventually start selling it on the market, right? VC tokens that have vesting schedules. Every single month they get more tokens and the price goes down because their supply increases, right? Like I said, tokens with predatory insider allocations eventually collapse over their own weight, just like it happened to me with RSR. Coins with deflationary structures like Bitcoin appreciate because their supply curve is designed to. And most people in crypto buy tokens without even understanding the tokenomics schedule and what actually this is about. And I'm going to make a long form video about this one day, explaining exactly what you have to look out for in the tokenomics. The unlock trap. So like I said, most VC coins follow the fiat model very closely. Ever increasing supply dumped on retail. Retail often thinks that sentiment killed a coin. A lot of the time, it's the tokenomics. So the rule is, if the tokenomics are against you, the outcome is already written. Law number 5, early holders control the chart, the motive that shapes the market. Early holders, especially with meme coin, they really decide everything. The top 10 holders, which will be the project founder, the insiders, maybe a few KOLs, if they really believe in the project, if they really believe their project is going to grow, and they really believe this. And this is why it's important to vet the team before you buy the token. If the team's professional, if the team's already rich, if they've already ran a lot of tokens before, you have proof and confidence that they're going to run this to high numbers. If the team is very poor, they don't have connections, they're not likely going to hold it all the way to $1 billion in market cap. Early holders control the chart. Holders are dumpers. Early holders are either long-term thinking, like I just said, or extractors. Long-term thinkers hold through huge volatility. They give confidence to the market. They have a big vision for the token, and they are not willing to sell for low prices. Extractors dump on every spike, drain momentum. This behavior shapes the entire life cycle of the token. A chart with disciplined early holders can trend and perform excellently. A chart with impatient and extractive insiders never stands a chance. And Brett is an excellent example of this. Brett, the main meme coin on base, so it's up there with Toshi. Brett had a lot of insiders at the start. And I remember looking at Brett early on. It had a lot of insiders holding supply. It's what's called a bundled supply, meaning that the top 10 holders hold like 60 or 70% of the total supply. Massive. I was concerned because I thought these guys were going to dump. But actually, they didn't. And props to Brett. They held for a long time. Brett overtook Toshi. And it went all the way to $2 billion in market cap. This is a very good example of the insiders holding and having conviction in their execution and in their project. The rule is, don't just check supply. Check who holds it, and what their incentives are, and why. Their intentions decide everything. Law number 6, narratives are manufactured, not discovered. So DeFi Summer, Airdrop Meta, Soul Season, AI coins, none of these coins and trends appeared out of thin air. None of them. They were all kickstarted by insiders who needed fresh liquidity, because insiders and the people that really control the market, they consistently need liquidity and volume to make money. So what do? They spin up a new story, they spin up a new narrative, they spin up a new meta. 90% of the time, I'm not saying all the time, guys, I'm not black and white here, the world is grey, but 90% of the time, the narrative is simply organized marketing disguised as organic discovery. The perception trap. Retail traders think that these metas are genuine and organic breakthroughs driven by innovation. 10% of the time, sure, they are. 90% of the time, they're literally engineered narratives. Look at BSC season, BNB season. That was not organic. That was CZ and the insiders shilling Abster. Asta went up loads. A lot of insiders made money. And then they started the BNB season. All orchestrated, okay? So just be aware of this. So the rule is, narratives aren't opportunities, they're campaigns. People who manufacture them take profits from those who get in late and follow them. And we're honestly just scratching the surface, guys. The rest of these laws are really where the meat is at and where we get into the bigger macro side of things. And these are the most important laws in my opinion. Law number 7, Bitcoin sets the tone. Bitcoin's the daddy of crypto. We all know this. Bitcoin is the king. When Bitcoin goes up, people take risks. When Bitcoin dumps, everything implodes. Everything in crypto is correlated to the movements of Bitcoin. It's just how it works. And the reality is, if you're in crypto and you want to buy anything other than Bitcoin, your main reasoning should be to outperform Bitcoin. Let me repeat that one more time. If you want to buy an altcoin like Solana or Sui, your reasoning for buying this altcoin is that it should outperform Bitcoin. Everything you do in crypto should be an effort to outperform Bitcoin, because Bitcoin is going to go very high. Bitcoin is going easily over $500 per Bitcoin eventually. So you want to be buying things that will outpace it. To be honest, it's getting harder to do this. 2017, 2021 bull markets, it was easy. You could buy anything, it would go up. RSR 40x, COTI 10x, Strong 10x, some coins I bought. Now it's becoming harder because there's so many tokens, so much fragmented liquidity. You have to be a very skilled operator in order to outperform Bitcoins. And this is what I'm helping you with my videos. And this is my goal. So the rule is, Bitcoin is the benchmark. Treat it as a reference point for every single decision you make in crypto. Law number 8, the crowd is almost always wrong. The consensus trap. People post bullish takes when they're in profit. People post bearish takes when they're in profit, okay? And it's very funny because it creates an illusion. The whole market is either bullish at the tops or bearish at the bottoms. And this is very, very true with crypto. And the reason why is because KOLs and people on Twitter, they have an incentive to be bearish at the bottom because it gets more impressions, just the way it works, right? And they have an incentive to be bullish at the top because you're going along with people's incentives. People don't want to have cognitive dissonance, as it's called. They don't want to have like a dissonance between what they're feeling and what they're seeing. So if we're at the bottom and I say, guys, we're super bullish, we're going to go up, everything's looking amazing. It creates cognitive dissonance inside of them, so they don't like it as much. But things that align with their takes, Bitcoin's over, guys, just go touch grass, go and get a normal job, they like this. So it's unfortunately just an incentive trap. The attention signal, an interesting phenomenon that I've experienced, and honestly people don't really talk about, is that when you hear about a coin on crypto Twitter or on YouTube or from your friends, that is the most likely time to be the top. Unless your friend is a real crypto operator and he really knows what he's doing or she really knows what she's doing, most of the time you're going to hear these coins at the top. Because at the top of a coin, most people are in profit. Everyone is in profit, apart from the very person that bought the very top. And these people have an incentive to shill the coin. Everyone's happy, the vibes are great, everyone's in profit, everyone's expecting a lot higher. They have an incentive to shill it. At the bottom, the exact opposite happens. And funnily enough, the bottom is the best time to buy. So this is almost, it's very ironic in my opinion. So the crowd is almost always wrong. The rule is, the louder the crowd gets, the later you are. Law number 9, price action is psychology mapped. Emotion creates structure. Many people believe that price action is just random, right? Oh, it's just random technicals. You get a head and shoulder, you get a break of structure, you get all these funny, some weird technical analysis, and it's not. If you can actually read price action well, you can decode the psychology of the participant. Price action isn't just technicals. It gives you an insight into what people are feeling. It tells you if people have lost faith. It tells you if people are euphoric. It tells you if people are uncertain. It can show you if whales are accumulating. It can show you if whales are distributing. And this is the beauty of price action, okay? It's psychology mapped. And the social map. Charts don't show fundamentals. They show how people react under pressure. Greed at the top, hesitation in the middle, fear at the bottom. When you're reading the chart, you are reading euphoria. And like I said here, euphoria looks green, depression looks dead with little volume and no attention. So the rule is you don't trade charts, you trade human nature. And that's the beauty of price action. Law number 10, narrative speed wins. I don't hear many people talking about this. By the way, all of these laws are from my personal experience. I've been in crypto since 2017, a very, very long time. These are the main things you guys have to know in order to win. This one's very important. Narrative speed wins. Fast interpretation equals edge. The people I know that have made the most money in crypto are not the smartest, you've heard this before though, but they're the quickest at understanding and internalizing what a narrative means. What do I mean by this? Well, they hear a story forming, they're able to decode it quickly. And they put in effort, they decode it quickly. They think to themselves, okay, I see this narrative forming. What does this mean for this coin? Okay, this means X, Y, Z. Oh, that means that this coin is very undervalued. It could go 5, 10x from here. Okay, I should buy it now. And they act within an hour, or they act within 5 minutes, right? Depending upon the time frame. The speed of internalization becomes the speed of profit because they're literally beating everyone else who's slower at internalizing the narrative and therefore buying the token, and they're slower at buying the token and therefore buying the token after everyone else. And that's why they make money because people are buying after them because they've internalized the narrative slower. And the narrative half-life, the funny thing about this is that every narrative has a window where asymmetric gains exist and it plays out on every fractal of every time frame. It could be multi-cycle, it could be single cycle, intra-cycle, right? So an example is Bitcoin. If you understood and internalized the narrative of Bitcoin early, freedom of currency. Fiat currency is really, really bad. After 2008, we had a lot of printing. We need digital gold, right? We're moving to a digital world with AI, okay? If you understood Bitcoin early, you captured a decade of upside, a decade of asymmetric gains compared to gold and the S&P. If you understood Solana early, the casino chain, right? You captured a cycle of upside. You got like a 20, 30x, right? If you understood a meme coin early, like Fart coin or another meme coin, you captured a few weeks of crazy upside. And the pattern's the same. The earlier you decode the story, the cleaner and bigger the reward is. And once the crowd finally understands it, the move is already priced in, okay? Information versus execution lag. Most traders fail because they wait for confirmation. So you shouldn't wait for confirmation. You decode the story, then you buy. You don't decode the story, then wait for a pump, then buy. Or you don't decode the story, then wait for a KOL to tweet about it, then buy. Because then others are getting in before you, and it's a PvP game, as we've established, and then you're going to be buying at a worse price, okay? So the rule is, the faster you synthesize and internalize a narrative, the more you profit. Simple. Law 11. Now, this is one a lot of people struggle with. Emotional attachment is fatal. Don't marry your bags. Identity kills performance. Most people don't just buy a coin. They attach their ego to it. This happens so much. It's crazy to me because I have attached my ego to a coin before. That's why I've learned, but now I don't. Crazy. When price goes up, they feel smart. When it goes down, they defend it. Once you combine your ego with a position, you stop seeing clearly. I've seen this so many times. Okay? This shift alone has wiped more portfolios than bad entries ever have. The ego trap. Emotional attachment, like we say in crypto, marrying your bag, creates a bias, right? Because you see evidence going against you and you start to tell yourself, oh, it doesn't matter. Oh, that's fine. The founder doesn't care anymore. Oh, no, it's fine. The coin's going to be fine. Oh, no, that doesn't matter either. You start deluding yourself. You don't see reality clearly anymore. That's the biggest thing that's very dangerous about this. They'd rather hold a losing position than admit they backed the wrong narrative because they got an ego, because they want to be right. And as men, we have this more than women, I think. I think women are better at this than men. I think men, we have a lot of ego. Community delusion. Retail hide inside Telegram groups. Discord and cult-like communities feel safe. It's a relic from our evolutionary wiring. Our evolutionary wiring, we wanted to be in a community. We wanted to be safe. And in crypto, they actually take advantage of this. You join a community, and if you sell your bags, you're betraying everyone. No, don't hold. Hold. We're going to $1 million. We're going to $1. Don't hold, otherwise you'll let your community down. And if you sell your tokens, you're kind of out of that community as well. So you kind of have an incentive not to sell them. You've got to just completely ignore this. Don't even get part of the community that much, okay? Crypto has a long history of groups marrying their bags, marrying their tokens, marrying their NFTs because the community, while founders and insiders quietly exited. If you knew what the founders and insiders were doing while you really believed in the community, you'd be disgusted. Not all the time, but a lot of the time. Leader attachment, same thing as the community. We're wired to follow charismatic leaders, and this is what a lot of crypto communities have. I'm not going to name any names, but there are some very famous projects that have very inflationary tokenomics, which means it's extractive, and they have a very charismatic leader. And a lot of people believe it. They fall for it. They tell themselves, oh, this guy couldn't let the project fail. No way, he would never let the project fail. Well, guess what? He's dumping on you. Not every token. I'm not saying everyone, but some of them, they're dumping on you. You need to be aware of this. Stay level-headed. Don't get emotionally attached. So the rule is, never marry your bags, a community or a leader. Stay married to reality. Law 12. Realized profits are the only profits. Paper gains do not exist. Unrealized profit is genuinely an illusion. Numbers on your screen don't mean anything until you've sold to stable coins or Bitcoin. I've seen so many people give back life-changing gains on meme coins or other coins. They make crazy gains. Let's say they started with 10K in the cycle. I saw this a lot with Abstract, actually. A lot of people ran Abstract coins from 10K all the way to like 200, 300K life-changing gains. I'm not saying they should take all of it out, but they should take some of it out. Did some of them take any out? Some of them took none out. They lost all of it. They ran it back down to 20K, and they just worked to load for nothing, okay? The truth is that most traders don't understand not everyone can cash out at the same price. Liquidity is thin at the top. Buyers disappear. The chart you're looking at is not a promise of the money you'll make. It's a snapshot. Until you hit sell, your gains are just an illusion. Survival mindset. The best traders and investors understand this. They sell into strength. They hold Bitcoin or stables. They keep it for a rainy day because it's not always going to be euphoria. We're going to get dips in the market, and you want to buy dips, especially if you're buying Bitcoin. So the survival mindset, like I said, this kind of survival compounds more than people think. And the rule is your gains aren't real until they're in stable coins or Bitcoin. Everything else is just an illusion. Crypto has rules. Break them, and the market will take everything from you.